Hello and welcome. We have put this video together as we wanted to give a bit of insight into what happens in our investment committee. Chris Liudis is here from Sydney, joining us in Melbourne. And while he was here, I thought I would get together and do a brief video that helps explain what happens with an investment committee, who's involved in our investment committee, and how it may benefit clients that are invested in any of our underlying investments. So to start with, our investment committee consists of 3 business groups and a few individuals. We have Dan Rake, who has north of 20 years in financial planning and the financial planning industry. Stu Maunder, who has over 15 years of experience as a financial planner and in the financial planning industry. Myself, who is a CEO of Freedom Finance and Boutique Wealth Australia. We have Lonsec, who is one of the biggest research houses in the country outside of the big 4 banks. And we also have Ironbark, who also manage billions of dollars, who work as our RE. And on top of that, Chris Liudis, we have yourself and your broader team. You are a big contributor to our investment committee. You bring a lot of insight and help us with picking our portfolios. I might start by getting you to tell us a bit about yourself and maybe your broader team as well, the people who work behind you.
Cool, thanks, Chris. My firm is Insight Investment Consultants, and so we help financial planning firms all around Australia in terms of helping them with their investment proposition. So we help them run their research effort in relation to portfolio construction, investment selection, and also in relation to things like investment committees, which we're talking about today. My business has been around for 10 years now, and the business currently consists of 4 people. And that business has been building over that period of time. And so I'm the lead consultant. We have some researchers in the team who are squarely focused on researching day in and day out, reading a lot of material. We also have someone else managing the business side as well. Like I said, 15 clients nationally. We would talk to roughly $20 billion of client fund in terms of what we're advising on, and been doing this for north of 15 years now.
Fantastic. So, and tell us a little bit about, prior to setting up the business, what did you do prior to going in and running your own business? Who are some of the companies you may have worked for, or where was your background prior to going out and running this yourself?
Yeah, so prior to launching my own business, I worked at Commonwealth Bank of Australia in the advice research team. So there I was responsible for running the model portfolios, the approved product lists that advisors used, and also sitting on structuring investment committees for the broader wealth business. So that encompassed about 1,600 advisors nationally and 5 licensees, and so did that for about 5 years, and started effectively at the depths of the GFC. So I got my first financial crisis straight off the bat, and learned a lot in the very first couple of years.
Fantastic. So a wealth experience there. I guess for someone that was using our investment committee, what is the difference? If I was a client and I was comparing a financial advisor that may have been standalone, I'm the advisor, I'm picking your portfolio, or if they had the benefit of getting access to an investment committee. So if I wasn't aware of the differences, where do you feel an investment committee adds the most value?
Yeah, so the key part with an investment committee is it adds rigor and structure to the process. So what it does do is it formalises the process in the sense that you've got people sitting around a table who have helped build the process and buy into the process. And that group of people meets regularly, so on a monthly basis, to monitor portfolios and discuss the positioning of those portfolios. And it's good to have a variety of people around the table with a variety of experience in particular areas, and that way you're getting different inputs. And that committee is charged with critically analysing the portfolios to make sure that they meet their stated objectives, but also to make sure that they remain best in class. And so the rigour that adds to a financial planning firm versus a firm that doesn't have an investment committee structure is quite significant in terms of the ongoing monitoring and reporting, and also the scrutiny that the portfolio is placed on a regular basis.
I guess to give a client the idea of how much work actually goes in. So we've spoken about how many people are part of our investment committee, but just you and your team, if you think of how many hours you spend specifically talking to funds, reading market commentary, whether it's the latest economic news that's coming out from America, the Fed, Australia, digesting those bits and pieces, looking through an actual fund manager's portfolio, seeing which stocks they currently hold, having an actual glance at what trades they're going through, why they're holding specific funds, comparing them to their peers, and also comparing them to the broader market to see how they're performing. How many hours a week goes into just that? And as you mentioned, I believe there's 3 or 4 people in your team. So how many hours of research would go in before you guys are able to comfortably formalize opinions about who you're using, why you're using them, and other kind of components?
So on the fund manager front, in terms of meeting with portfolio managers, our team would meet with 4 to 5 portfolio managers per day. Obviously that's an extensive due diligence process. We're actually sitting in front of the portfolio manager, usually in person, but if not in person, if offshore via VC. That's either multiple members of my team or just one particular member, depending on the research work that we're doing. Outside of those, obviously in those meetings, we're critically analysing the fund manager in terms of their ability to do what they say they do, but we're also taking in information as well. So in those meetings, these are investment professionals around the world who are managing a portfolio on a daily basis, and so we get live information from them as to what they're seeing and how they're seeing it, which is critically important to our process. Outside of that, obviously, we obviously receive a lot of information. We're an inbound repository of information from all parts of the world, whether it's economists, brokers, fund managers, central banks, and a lot, and we read as much information as we possibly can. We make sure that we don't read one source of information. We make sure we read a variety of sources of information, and we really try and test our thesis out in terms of our base cases and the like. So we want to make sure that we're not just reading the same material, we're not reinforcing any sort of bias we might have. So we actually want to make ourselves quite uncomfortable when we are doing that research. So we'll read something that we think is quite odd or quite left field, but we'll do that to sort of counterbalance the information that we are reading to make sure that we're getting all sides of a particular thematic or story or investment thesis.
And so just to put in context some of the things that we do look at, I guess, areas that we are concerned about or pay close attention to with our investment committee is a number of things. We have different style of portfolios. We have defensive portfolios. We have more growth style portfolios. Now, typically, growth style portfolios would be known as portfolios that invest in shares, property, infrastructure. And when we say that, we have a lot of options available to us. Just to name a few, you have large companies in Australia, which would be Commonwealth Bank, BHP, CSL. But you also have small companies in Australia that may only be turning over $20 million, where your large companies might be turning over billions of dollars. And so we segregate how much money might go into large companies, how much money might go into small companies. And then on top of that, we look at international markets. So whether we're looking at the US, how much we might put into, whether it is the US, large companies, small companies, whether it's Europe, whether it's emerging markets. On top of that, we're also looking at property, infrastructure, and a number of different asset classes. So coming together and forming an opinion around where the end client's money might end up is not only comparing Australian fund managers against Australian fund managers, but it's also deciding, is the money best in America if their economy might be going the best, or the companies there might be more profitable or trading at a discount. If we're looking at small companies compared to larger companies, if they're trading at a discount, or what their growth rates look like, there's quite a bit that really kind of goes on. How do you guys go around helping form opinions around where to place the end person's money?
Yeah, so with regard to, broadly asset allocation, so which asset classes and which parts of the world we're allocating money to, obviously we have a sort of a neutral setting, a strategic asset allocation, if you like. So that's our base setting, and that's based on long-term forecasts. So we're using long-term risk and return forecasts there to have that neutral setting. But that neutral setting obviously needs to be tested and adjusted through time because markets do change quite frequently. So we are testing that base setting regularly to see if it needs adjustments. And those adjustments are at the asset class level, or they might be at the investment approach or style level, or it might be at the particular market level like you just discussed. So in terms of large cap versus small cap, or versus developed markets versus emerging markets. So we are looking right down to those sort of levels. And we are, like I said, capturing information from a variety of sources and looking at relative valuations between those regions. We're looking at, from a macroeconomic perspective, which regions and which sectors we think will be most supported over the next 12, 18 months to sort of form that view. And then obviously accounting for the fact that there's obviously risks in markets as well. So trying to avoid some of the pitfalls and risks that sort of come up, but also making sure we take advantage of opportunities as they come through. And so we've got full look through of all portfolios in terms of the managers we allocate to. We know exactly where they're allocating to at any point in time. We can get some comfort around where they're allocating and how they're changing the portfolio, or how their thinking is changing.
Yeah, great. So I guess just to reiterate, looking at these kind of components, it's not as simple as just using kind of one fund manager. It really does come down to, and even talking about today's current climate, where we've got wars over in Europe, we've got large economies as big as China coming out of COVID zero. We've got huge things going on globally, that you can't just be around what a company's earnings are doing and how does a company stack up. But if that company is in Europe right now and it's potentially being affected by war, or could be affected by war, if it's in a place like Asia at the moment, and where China's coming out of COVID zero, if it's in a place in America at the moment and how that's being affected, there's a number of different things that you guys would need to be around from a high macro level before you even start looking at the micro level on how that company compares to its peers. And then, as we said, we'll use underlying fund managers, and you'll have to pair them up against their peers prior to actually making a decision about where the funds actually add up. I guess talking about this, what is the end goal for the client? So it's great. They've got people that are doing all these look-throughs, that are looking at it from a very high level on where every dollar is actually placed, down to which country or region, whether it's a large cap, small cap, which fund specifically we want to allocate to. Why should a client care about this?
So the two critical parts, I think, for us is that, the first part is preservation of capital. So we need to make sure that when we are allocating client capital, that it's what we call money good. And money good is that an asset will stand the test of time. So all assets have volatility and fluctuations in price, and it's obviously difficult to mitigate that on a regular basis. But we need to make sure that investment we place today is still there in 1 year, 3 year, 5 year, and 10 years' time. We need to make sure that client capital that clients have worked a lifetime for is sustained through time. So obviously we're ensuring that we're picking the highest quality investments. We're making sure we've got no defaults in the portfolio, and making sure nothing goes to zero. So that's the first critical point. So there's some comfort that can be gained on that in that respect. And that takes a lot of time, a lot of effort in terms of making sure that we navigate towards those particular investments. And the second part that's equally critical is making sure that the portfolios meet their objectives. And we've got set objectives for each portfolio, and we need to make sure and measure ourselves over time that they're actually being met. And if they're not being met, we need to understand why and make adjustments. And so they're the two critical parts, I think, that we do spend most of our time to. And that's what you can sort of summarize the overall outcome down to, is preservation of client capital, and then making sure that those objectives are met through time.
Yeah, fantastic. And so I guess, the big thing that I take away there, or another way of describing it, is you're not out putting it all black. You're not out taking big risks, I guess, which gives us heart knowing that a large part of our client base are pre-retirees and retirees. And so knowing that we have someone that first and foremost looks after preservation of capital, not taking too many risks. Obviously, between the client, their advisor, they'll discuss how much they want to invest defensively and how much they want to put in growth assets. But with that, looking at the best quality fund managers that are going to deliver a good return over the long term, but not take undue risk. And then you guys over top deciding on where you're putting it, because even if the fund manager is doing their best job, if it's in a country, and we've seen some emerging countries whose currencies have arguably halved. So even if the company did everything and the fund manager did everything they did, but it was invested in a place where the currency halved compared to the Australian dollar, or there was undue kind of macro risk where there was a war, or there was other bits and pieces, just making sure that we're not taking those risks as well, even if the underlying company was a very good company. Well, I think that gives a very good initial kind of idea how much work goes into an investment committee And I do think that some people will benefit from this. And obviously, if people do have additional questions, we can try and tackle those some one-on-one or through their advisor if they want to ask specific questions. Thank you very much for your time today, Chris. We appreciate you coming down and joining us for this video.
All right, thank you.